Today we're covering the most important stock terms that you need to know, and we're gonna get right into it. But if at any point in this video you feel like you're getting value from it, please give me a thumbs up because it really helps out. First things first, stock market and shares. The stock market is a collection of buyers and sellers of shares of stock. The first stock exchange was a roofless courtyard in Amsterdam back in 1611. How it's looked has evolved over the years, but these days it's completely computerized. Shares represent an ownership claim on a business. If you're a shareholder of a business's stock, it means that you own a percentage of that business. Or in other words, you own a share of the company's ownership. Shares outstanding. Shares outstanding is the number of shares a company's ownership has been divided up into. If you own 1% of the shares outstanding, you own 1% of the company. Simple as that. Market capitalization. Also called market cap for short, it's calculated by taking a stock's price per share and multiplying it by the number of shares outstanding. For example, a stock with a share price of $14 and 10 million shares outstanding would have a market capitalization of $140 million. This can be otherwise thought of as the market value of a company. Ultimately, it's the value that the market of buyers and sellers has collectively put on a company at any given moment. Insiders. Company insiders are the directors, the officers, and the key employees of the company. Insiders can be shareholders, and when they are, it's a good thing because it usually means that their goals will be aligned with yours as a fellow shareholder. Institutional investors versus retail investors. Mutual funds, pension funds, insurance companies, and college endowment funds are examples of institutional investors. They're organizations that trade and invest large amount of other people's money. The opposite of an institutional investor is a retail investor. Retail investors are just individuals like you and I who are investing their own money rather than giving their money to an institution to invest it for them. Speculators versus investors. There's really just two ways to participate in the stock market, which are one, as an investor, or two, as a speculator. Investors think of shares of stock as the ownership interest in a company that they are, whereas speculators instead are looking to profit off of the psychological aspects of market behavior, and instead of focusing on the fundamentals of the stock's business, they focus on its price action. Stock index. A stock index is really just a hypothetical portfolio that represents a segment of the stock market. Stock indexes are useful because they give us a benchmark to compare investment results against. The S&P 500 is the most popular index and benchmark for people to use, and it's a pretty good representation of the US stock market as a whole because it's made up of the 500 largest publicly traded companies in the US. Index fund. An index fund is a fund of stocks that investors can buy into to own a diverse portfolio of stocks under one fund. Unlike most funds that are actively managed, an index fund is managed passively and simply replicates the stock holdings and their weightings as dictated by an index. I mentioned the S&P 500 as the most popular index, and there's 3 different S&P 500 index funds at this time that you could choose from. We've got the SPY, the VOO fund, or the IVV fund. All of these funds do the exact same thing, and besides a little bit of wiggle room for tracking errors, they all achieve the exact same results, which of course is the same results of the S&P 500 index. Investing in index funds, particularly broad market index funds like these ones that I just mentioned, has become a more and more popular strategy over the years. And this has been due to it becoming more and more apparent that actively managed funds on average actually do worse than their index benchmark. And a lot of this underperformance of the actively managed funds has had a lot to do with these actively managed funds fees. Actively managed funds typically have annual fees of 1, 2, or 3% plus, and these fees really add up over a 20 or 30 year time period. Index funds, on the other hand, have very low annual fees, and these fund fees, by the way, are also known as its expense ratio. ETF. ETF is short for exchange traded fund, and it's a fund that can be bought and sold very easily during stock market hours in the same way that shares of stock can be bought and sold. The funds I just mentioned, the SPY, the VOO, and the IVV, are all exchange traded funds. ETFs can be for both index funds or actively managed funds. Efficient market theory. This is a theory that suggests that all stocks are efficiently priced at all times, and that all publicly available information and expectations for the future are reflected in the current price. Efficient market theory would tell you that it's impossible to outperform the market, and that you're always going to be better off just investing in an index fund with the lowest expense ratio possible. And this is exactly what they teach in business schools as being the truth, although its popularity does seem to ebb and flow over time. Warren Buffett, as a value investor, although he does agree that low-cost index funds are the best way to go for most people, would very adamantly disagree with this efficient market theory. Buffett would tell you that stock prices are not perfectly efficient, and that, at least in the short term, emotions like fear and greed play a large role in the price of stocks. Bubble. A stock market bubble happens when stock buyers drive up the price of stocks far above their intrinsic value. Prices are driven higher higher and higher, usually by a combination of greed, exuberance, a lack of understanding, and our human tendency to just follow the herd. And they're called bubbles because just like other bubbles, eventually they pop. Crash and correction. The official definition of a crash is when the market drops by 10% or more in a single day. A correction, on the other hand, is more of a gradual decline over weeks or months of 10% before prices start to rise again. Bull and bear market. A bull market is how you could categorize a market that is rising, whereas a bear market is when the market is down typically 20% or more from its previous highs and over a sustained period of time. If somebody says they're bullish on the market or on a stock, it means they think it will go up in price. If someone says they're bearish, it means they think it will go down in price. Stock quote. If somebody looks up a stock quote, it means that they're looking up the latest price that a share of stock traded for. The quoted share price for any stock or ETF is always just the last price it was traded at. Bid, ask, and spread. The bid price represents the current maximum price that a buyer is willing to pay for a share of stock. The ask price represents the current minimum price that a seller is willing to sell their shares for. So if you're buying shares and you want your order filled immediately, you will need to put your buy order in with a limit price that is at least as high as the ask price. And if instead your buy limit order is in the market at a price below the current ask price, then it will just sit there as an open order in the market until a seller comes down to meet you at that price or when your order is canceled. On the other hand, if you own shares and you want to sell them and have your order filled immediately, you will need to put your sell limit order in at a price that is at least as low as the current bid price. The difference between the bid price and the ask price is called the spread. Every single time a trade takes place, the price that trade was done at becomes the last price for the stock. And it's this last price that is graphed and presented to you in most places when you look up a stock quote as a way of seeing what the stock has been historically trading at. Technical analysis. Technical analysis is the act of looking at historical price charts and using them to predict where the stock price will go next. In the world of technical analysis, there's a bunch of additional indicators that can be added to price charts, like moving averages, for example, and there's a whole school of thought dedicated to reading and deciphering price charts to help make guesses on what the price will do next. And you'll definitely see a lot of ads, by the way, from people claiming to teach you how to use technical analysis to guess the future price movements. People who use technical analysis to make stock buying decisions are in that speculator category rather than the investor category because they don't really care about the underlying fundamentals of the businesses the stocks represent. They just focus on historical price patterns. Fundamental analysis. Fundamental analysis is the opposite of technical analysis and only focuses on the business's underlying fundamentals. People who use fundamental analysis look at things like the income statement, the balance sheet, and the cash flow statement, which all public companies produce on a quarterly and annual basis. Fundamental analysis focuses on the future prospects of the business, how much cash it will be able to generate in the future, and what the business is worth to them as an investment. Earnings per share, or EPS for short. On the income statement, the very last line at the bottom states the company's net income for the time period of the statement. This net income amount tells us how much profit a company has made after subtracting all the costs, expenses, and taxes. If you take this net income number and divide it by the number of shares outstanding, the result is the earnings per share. In other words, it's the net income, also known as earnings, that is attributable to one share. Price to earnings ratio. The PE ratio is calculated by taking a stock's share price and dividing it by their earnings per share. Ultimately, it's a valuation metric that tells us how cheap or how expensive a stock is. If a company had a share price of $14 per share and earnings per share of $1.20, it means that stock has a PE ratio of 11.7. If another company had a share price of $50 per share, but it also had earnings per share of $1.20, it would mean that it has a PE ratio of 41.7. If all things were to be equal for the future of these companies, the one trading at just 11.7 times its earnings would be cheaper and a better investment. Now, one of the limitations with the PE ratio, however, is that it doesn't at all take into account the future earnings, just the current earnings right now. Earnings yield. The word yield on its own just means to produce or to provide. The way the earnings yield is calculated is actually just the inverse of how the PE ratio is calculated. Instead of price over earnings, it's earnings over price. So from the previous example, it would be the $1.20 earnings per share divided by the $14 price per share equals an 8.6% earnings yield. Or for the other example, $1.20 earnings per share divided by the $50 price per share equals a 2.4% earnings earnings yield. Again, if all things were to be equal for the future of both of these companies, then the first one would be a better investment because it would yield us a return on our investment of 8.6% in our first year of ownership, assuming the company's earnings stayed the same. Investing in the second company instead would yield us a return on our investment of 2.4%. And obviously, when you look at it like that, it's easy to know that one would rather have a yield of 8.6% rather than a yield of 2.4%. Dividend yield and payout ratio. Dividend yield is very similar to earnings yield, but instead of it being earnings over price, it's the company's annual dividend amount over price. If our example company pays out and distributes half of the earnings it makes to the shareholders, it would mean that the company pays an annual dividend of 60 cents per share and has a payout ratio of 50%. We're saying that the dividend is 60 cents per share here because that's half of the earnings per share amount of $1.20. And we're saying the payout ratio is 50% because we said that half of the earnings are being paid out, or in other words, 50%. Dividend yield is calculated by taking that annual dividend amount and dividing it by the price. 60 cents divided by the price of $14 per share gives us a dividend yield of 4.3%. 60 cents divided by the price of $50 per share gives us a dividend yield of 1.2%. A high dividend yield is a desirable characteristic of a stock. However, that's not the only factor you'd want to consider when it comes to dividends. Retained earnings. Retained earnings are the portion of a company's earnings that aren't paid out to shareholders as a dividend. And although this portion of your earnings as a shareholder isn't paid out to you, you do still benefit from these earnings indirectly. Companies will use their retained earnings, for example, to pay off debt, which increases your equity, or that money can be reinvested back into the business so that more money can be made in the future. These efforts ultimately increase the value of the company, which should eventually be reflected in the share price as well once the market recognizes that increased value. So your overall investment return will come from a combination of both the dividends that you receive as well as the appreciation in the value of the shares that you own. Price to book ratio. Similar to the price to earnings ratio, the price to book ratio is a valuation metric that gives you an idea of how cheap or how expensive a company currently is. One of the financial statements that companies produce on a quarterly and annual basis is the balance sheet. The balance sheet shows us the assets, the liabilities, and the shareholders' equity. Shareholders' equity can be thought of as the net worth of the company. Assets minus liabilities equals shareholders' equity. If you then take the shareholders' equity amount and divide it by the number of shares outstanding, the result is the shareholders' equity per share, which is also known as the book value per share. Let's say that a company has $300 million of equity, which comes from $500 million of assets and $200 million of liabilities. 500 million minus 200 million equals 300 million. If the company has 10 million shares outstanding, it means that the book value per share is $30. $300 million of shareholders' equity divided by the shares outstanding of 10 million equals $30 of book value per share. If the company is trading at a price of $14 per share, the price to book ratio would be the $14 price per share divided by the $30 book value per share equals a price to book ratio of 0.47. In contrast, if another company had the same book value per share but was trading at a price of $50 per share, the price to book ratio would be the $50 price per share divided by the $30 of book value per share equals a price to book ratio of 1.67. So, similar to the PE ratio, when it comes to the price to book ratio, lower means cheaper. In the case of this first example here with the price to book ratio of 0.47, this would be considered extremely low. It's pretty rare for a company to have a price to book ratio that's under 1, and that's especially if it's a decent company. Theoretically, if you purchase enough shares of this company to have a majority ownership and therefore majority voting power, you could technically use your power and control to have the company liquidated, meaning selling off all the assets and using that cash to pay off all the liabilities and still be left with $30 of cash per share. If each share cost you only $14 and was able to be liquidated into $30, then that would make for a pretty solid investment. And as a little side note bonus lesson here, what I just described is actually a large part of how Warren Buffett made so much money in his early years as an investor. Not so much because he would gain control and have the companies liquidated, but more so because the share price of companies with below 1 price to book ratios would often eventually increase to the point of at least trading at a price to book ratio of 1 or higher sooner or later. And again, that's especially if they were decent companies to begin with that were still making a profit. Back in those days, after the Great Depression in the 1930s, finding stocks trading this cheap was possible. These days, it is much more rare to find stocks trading this cheap. And by the way, back in those days, Buffett would call this buying dollars for 50 cents. Value investing. A value investor is someone that, after doing their fundamental analysis and determining on their own what the approximate value of a business is, then goes ahead and buys shares of its stock if the current market price is below what they've roughly determined its value to be. It's called value investing because you're taking advantage of the inefficiencies of stock market pricing and buying shares when the market is pricing them below their intrinsic value. Now, by the way, depending on who you ask, value investing has different definitions. Some people would say that value investors are people who buy stocks with low PE ratios and low price to book ratios. However, a stock having low valuation metrics doesn't necessarily make it an underpriced stock. Remember, the price to earnings ratio and the price to book ratio simply provide us with a snapshot of how things are looking right now, and they don't take into account what the future will hold for a company. A large part of what value investors do is essentially making conservative predictions about the future. Some companies are easier to predict the future for. Think of a company like Coca-Cola. And then for some companies, it's almost impossible to predict the future for. Think of a company like a new startup that doesn't have any revenue yet. Growth investing. This one's another one that has different definitions depending on who you ask. Some would say that it means focusing on investing in companies that are expected to grow rapidly. For example, a company that doesn't have any earnings yet or even any revenue yet. Or perhaps it does have some earnings currently, but it's a company in the very early stage of its life and is expected to start generating a lot of earnings in the future and for those earnings to grow quickly. The thing with this is that a so-called growth investment absolutely could be considered a value investment as well, as long as you're paying a decent price in relation to the intrinsic value of the company. By the way, another little side note here is that I often see growth investing being described as the same as momentum investing, which by the way, I wouldn't consider to be investing at all, because momentum investing basically just means buying stocks that have been recently going up in price. I'd categorize this as speculation rather than as investing because the focus is on the price action rather than on the intrinsic value of the underlying company. Something Warren Buffett and his business partner Charlie Munger often like to say is that all intelligent investing is value investing. Intrinsic value. Warren Buffett would say that the intrinsic value of a company is equal to the total sum of all the cash it can generate in the future, discounted back to its present day value. In other words, the discounted present value of future cash. And this is really how you'd calculate the intrinsic value of any investment, whether it's a business, an apartment house, or a farm. As long as it's a cash producing asset, it has an intrinsic value. Now there's something called the discounted cash flows calculation, or DCF for short, that can be done to calculate approximately what an asset's intrinsic value is. Of course, the future is unknown, so there is some guesswork involved. However, value investors overcome this by staying conservative with their estimates for the future to give themselves an extra margin of safety. Nonetheless, the idea is that cash earned in the future doesn't have the same value as cash earned today. For example, if I hand you a $100 bill today, it should be worth more to you than if I hand you a $100 bill 10 years from now. And the reason for that is just because even if you were to just put that $100 into a low interest savings account at your bank, after 10 years, it would have grown to an amount that is higher than $100. If you want to learn more about the fundamentals of value investing and even just money management in general, I would suggest checking out this video right here. In this video, I also do an intrinsic value calculation example for a bakery business. Or check out this one right here if you want to get a little bit more advanced. I'm not a financial advisor, I'm just someone who loves investing, so please always do your own due diligence or talk to a qualified professional before you take any action on any of my content, and I'll see you in the next one.